out what the overall market texture is looking like, and Venugopal Garre, MD at Bernstein, joins in on the show right now to talk about exactly that. Venu, hi, good morning. Good to have you on the show. I want to first start off with your January upgrade thesis. While you were right about as to how there's going to be a spree of rate cuts and there is going to be a macro recovery in the second half of the fiscal, but tell me, with a 50 bips rate cut already implemented by the RBI, and then there's so much uncertainty across the globe, what is the view right now on how India is going to be shaping up?
Thanks for having me on the show. I guess in January when we spoke post the upgrade, it looked like an impossibility to expect any degree of positivity on the Indian market because the pushback was very high. Macro was very weak in second half of last year. And as you know, I was very cautious in second half of last year. My broader thesis to a large extent, interestingly, remains intact even today. So what it means is that I still have a positive outlook on Nifty with a 26,500 target. The perspective is very simple that macro for India, as I had indicated in January, had bottomed out. And more importantly, we are continuing to see some degree of improvements in macro. The second perspective was that I was actually expecting around 50 basis points of rate cuts, but that has already happened. And I do believe that, as you mentioned, uncertainty globally is actually good because that could lead to more rate cuts. And more importantly, from a regulatory standpoints and RBI in terms of what they're doing to ease liquidity in the banking system as well, it's a very positive, in terms of how things would shape up through the year and early next year as well. The other important point is that both capital expenditure, which I was indicating, and consumption will be slightly better than last year. So, at the rate of change, of course, is going to be positive compared to what was last year. But all these factors I've told you is not going to be so amazing that we can think of 25 or 30% returns from India, right? So this is the only limiting factor for me.
But Venu, isn't there a currency risk to that? Because, while rate cuts is, of course, one part of the story, the other one, of course, is, currency and the dollar parity. And looking at the world the way it is right now, the rupee depreciation, I guess, would be a big risk, right?
Yeah, it's a pretty interesting and a deep topic because in currency, the beauty of it is actually no one knows. I've seen a lot of theorists trying to take a call on currency and mostly people go wrong. So let me tell you my theory with the risk of going wrong. Broadly, at the beginning of the year, my view was that dollar index has peaked out. That was the view written in a report. And the dollar index over time will moderate. I didn't expect a moderation within the first 3 months. Over time through the year will moderate, which will enable primarily India to cut rates. So without having to worry about currency depreciation. So that was a broader thesis. But remember, at that point of time, we were aware of tariff risks, but we were not aware of 100% plus tariffs. We were not aware of those issues. Now, fundamentally, from here, what is the risk? The risk from here is if US and China eventually continue to be in the current situation, nothing improves out there, there is going to be excess supply of products or capacity with China. Now, what does China do with that eventually? It's going to find its way into the global trade ecosystem, either through dumping of products or through currency changes. So my biggest fear from here is not about dollar index, but what directly happens to Chinese RMB and what they actually do from a policy standpoint later in the year when we have an idea of how these things are shaping up. And that's when emerging market currencies, including India, potentially could be at some degree of risk. It's some way down the line, but not today.
Very good morning to you, Venu. The Shell also joining in the conversation, and it is heartening to note, and given the fact that you do have maintaining a positive stance on India, and it's pretty uncertain time. And you've written in one of your notes that running a portfolio also is no easy task, which means that the way the events have panned out, the complexity of the event also makes it very tough to actually align your portfolio to these trade talks, especially back and forth of this trade talk. So help us understand, how have you actually now tried to devise your portfolio, given the fact that you have a list of stocks that you're looking at right now?
Yeah, that is true. Honestly, it's very tough to build portfolios in such a volatile environment. Interestingly, the way we approached it this year was, since I was looking at a broad macro recovery and I was cognizant of the global risks, the idea was not to eliminate the entire global risk. That's highly impossible to do that. And probably portfolio sense also, it's wrong to do that. The second theory for us was to look at recovery candidates from a stocks standpoint, with the risk that we could go wrong on some of them, but the idea was to play recovery. The third was not to be ultra defensive, but have some defensiveness to the portfolio, because none of us like losing money, right? So these are the three characteristics of how I looked at things this year. So beginning of the year, the way our sector weights worked were that we felt that domestic stories should have a higher weight, which essentially meant that I ended up having my highest overweights in the financial sector. I have overweight on telecom, and I ended up upgrading utilities to an overweight. So these were the three defining overweights for us. We had moved to an underweight in healthcare. Remember, that was a globally exposed sector. Now, after 3 months of underperformance, we are equal weightage healthcare. We had a marginal overweight in IT services beginning of the year. We actually cut down the weights quite a bit through the year, and we are now more equal weightage, but not underweight IT. We are still playing it with particular stocks. And this is the contours of sectors, right? But from a stock standpoint, if you look at India portfolio, hasn't really tweaked much in the last 4 months, but has recovery candidates, which we had sort of included in that portfolio. Something like Bharti was added to the portfolio, Adani Ports was added to the portfolio. So we had some consumption names like Avenue Supermarts, and we booked profits in Zomato, but got into Jubilant. So it was a very wide range of bottom-up selection, honestly.
So that's the strategy. Go for a bottom-up approach. Hi, good morning, Venu. This is Shrishti also joining in. Let me touch a bit upon the IT space. Since AI is the biggest talking point right now, and we know that the US and China are definitely reading the race, but what's in the context with the Indian AI companies now that they have started talking about this transition? Do you believe that it could be a boon or a bane for the Indian IT space?
I'm a bear, so on this story, so which essentially means that I'm worried. I wrote a report called AI Unleashed, Game Over for Indian Jobs. I mean, I normally don't like taking such extreme long-term views, which are negative in nature. It's great to take extreme long-term positive views because no one knows. But the reality is that AI is very, very clearly disruptive. And the unfortunate reality of India is, yet again, we are consumers of international technology. And we have seen this over and over, almost every particular industry. We do not originate technologies, we do not originate innovation. We are primarily an unorganized to organized ecosystem in terms of corporates, or primarily labor arbitrage industries, be the IT or manufacturing. This is the unfortunate reality of India. So what it does is that as AI becomes more and more intelligent in terms of the features and offerings, there is going to be essentially issues with the industries which are exposed to that, which is the knowledge industries. At the lowest end of the industry, you will see the most disruption, and slowly it will start to hit at the mid end of that IT services industry over time. Nothing is going to be impactful in the next couple of years, because our theory is that the next couple of years we'll see volume of opportunity increase for IT services as more and more companies find it easier to implement IT solutions at lower cost. So volumes will increase first, and thereafter, once that swath of volumes go off, you'll essentially see potential risks coming in. The second part of this theory is essentially that it does lead to wage deflation as well from an Indian high-end services ecosystem. Wage deflation essentially means the approach to per capita incomes might have to change over time. So which essentially means the kind of products and kind of companies we look at perhaps might have to change. So there's a host of topics essentially, but we should worry. If we don't worry, then the story is over.
Right. I want to link it also to, what's happening on foreign flows, Venu. We did touch upon currency, and I guess that's going to be a big dominant factor. While month to date, we've seen a good amount of FI money coming back, but I don't know if it's really permanent in nature, or is it more sort of tactical, you think?
The interesting thing is even FIIs don't know whether it's going to be permanent. So I'll tell you a very quick story around this. The story is this, that most FIIs, when I say FIIs, I normally focus on emerging market funds globally, which are the main sort of funds which tend to invest in India. Global funds are typically have very small allocations. So these emerging market funds were either overweight on India or neutral on India, or were looking to add to the Indian market at the peak of the Indian market in July, August last year, when I was actually telling them to sell. The unfortunate reality is all of them, not all of them, most of them as a cohort were underweight India or equal weight India or looking to sell in February of this year at the bottom of the market. Now, what does it tell me? It tells me that there wasn't much of FII selling left, because if you're already underweight, the only risk would have been if there was a flow out of EM funds into any other cohort of asset classes, be it DM funds. But what I was hearing there is that money from DM itself has to move somewhere, because there was an over concentration of sort of exposure to US that the DM funds have. So either money within DM moves to different DMs, or essentially part of it comes to EM. So which gives me some comfort that FII selling had bottomed out. This is a report we wrote on March 18th. Now, going forward, the reality is that I think FII flows will be very volatile unless India gets identified as the biggest beneficiary of what is happening in the next 6 to 12 months in terms of supply chain shifts. I don't think there's going to be a very, very large FII inflow coming into India. It will remain volatile, but I don't really see exits. So worst case for me is over the next 6 to 7 months, no outflow with volatility. That's a worst case for me.
While you've given us the positive case scenario for the Nifty 26,500, but I was just going through one of your reports and it talks about a non-linear recovery, and I want to probe you a little bit more about that, because while you are saying that there is going to be volatility in the second half of 2025, elaborate on the key events do you think, or indicators that you're monitoring, wherein you think there is a scope for this linear recovery to be either a sharp recovery, or do you think it's going to be a volatile, wobbly ride to 26,500?
It's very tough to take a linear view out here, because there's so many global events which we discussed which are uncertain, including currency, including tariffs. Remember, we've got a 90-day, or probably another 70 days left. There'll be trade negotiations with the US. We don't know how that's going to shape up. And just more recently, Trump appears to be wanting to bring down the tariff again on China. So there's so many factors globally. Now, locally, if you were to look at also their volatility factors, the macro is improving, but it's not like a massive, massive recovery. If you see things like power demand, for example, every month there's a different data. So monsoons hopefully should be good, but what if they're not good, right? So, but yet I would be okay with macro this year versus last year. I'm just giving you a range of static thoughts, but the idea of this is essentially that unless there is a coherent reason to believe that there is going to be a sustained and a very sharp and a smooth recovery, markets are not going to be also shaping up in a very similar way. So you would see volatility essentially shape up through the year. And more importantly, if FII flows, let's say, are zero, let's say for the rest of the year, which is great because you don't want a negative flow, and domestic flows sustain at the current levels, I do see a lot of fundraising activity start again, which again leads to volatility in equity markets. And quite a few of them are not necessarily great companies, they're just timing the markets. But the reality is that sort of sucks in domestic liquidity. So you would see a lot of that shaping up over the year. We all want linearity. Non-linearity can be an opportunity as well, but this is the way I'm thinking about the rest of the year.
Just going to come to that, because it seems like that it's all so uncertain right now. Is there any sort of contingency plan that investors could have here in India? Anything which is a safe haven or a foolproof sector or stock?
It's more about not losing money. Honestly, utilities is a very safe sector. You won't lose money in that. So that's the only thing I can call out, perhaps, which is more safer. Consumer is in theory safer. Consumer staples, but I'm equal weightish, but it's very costly sector. So the point is, if you want safety, equities is not the place. Even though I'm advocating equities, then the question is, what is a safe asset class? The safest asset class is cash and fixed deposits. And I have currently zero exposure to cash and fixed deposits because I was playing recovery. So it's a question of how people approach it, or perhaps get into real estate, not as stocks, but essentially, investments into real estate, because I don't think that story is over yet. There could be price appreciations in real estate over the next couple of years. So it's an asset allocation call people definitely have to take.
Venu, do you believe that one can play the real estate story with some of the real estate counters as well, given the fact that we have seen a bit of a correction in that particular sector, and there was a bit of a valuation concern as well? But with this correction, do you believe that would be a good idea?
I don't think it is a bad idea. I may not necessarily call it as a good idea. It's not a bad idea. And interestingly, in my conversations with foreign investors beginning of the year in February, and particularly in February, I'd written in one of my reports, which was called as 100, discussions and 100 opportunities. The sector which came out to the fore was the Indian real estate. I'm talking about stocks. And I was very surprised, and I was asking everybody, why are you all working on the Indian real estate stocks? They're so small. And the rationale was very simple, that look at the correction they've seen YTD. That was number one. All of them have pre-sold a lot of property. So there is visibility of earning streams, at least for the next 3 years. So isn't that safe enough, given that the narrative itself for the next couple of years or 8-10 years is decent, right? So putting valuation aside, it appears to be one of those spaces where there is going to be a potential flow of money from investors as well. So not a bad idea, but I don't know whether it's a great idea.
Right. I just want to shift back actually to talk about your portfolio allocations and especially the sector allocation. You've always liked the power sector. Correct me if I'm wrong on that particular front, Venu. And do you think that this will be your go-to sector and continued go-to sector, given the fact that we are now looking at a shift in the way how people are thinking of aligning the portfolio to domestic-oriented counters?
Not, interestingly, I have been a bear on power sector for a decade, if you were to look at 2009 onwards. And I used to tell people that utility sector is not meant for equity investors. I had gone to that extreme as well at some stage couple of years back. Now, I have dabbled with the utility sector in more recent times in terms of, opportunities from time to time in a positive sense. If I were to look at the call today, I actually upgraded utilities from a neutral to overweight in January. So it was a change of view from neutral to overweight, with NTPC kind of stocks being added to the India portfolio. I also have Power Grid in the India portfolio now. So it's not about safety. I was also playing potentially one part of India's story over the next 3 years, by the way, where I do believe that within capital expenditure areas, power is the one which has a lot of opportunity, where again, quarter to quarter, you might see volatility and variation, but over a 3-year view, this is the area where you would see a lot of business and opportunity coming in, but both the capital equipment companies as well as the utilities. But since Capex stocks or industrial stocks, which are exposed to power, were really, really high in terms of valuations, I wanted to play it through utilities rather than through cap goods.
Venu, while you've highlighted really what the portfolio construct should be like, and not put your eggs in one basket, diversify. But tell me, when it comes to the long-term India view, are you getting the confidence that India will manage to sort of wade through this entire global storm, if you will?
I'm pretty confident that long-term is a tricky word, because long-term, I have realized it's very, very tough to take a call given all the disruptions, right? It could be very bad for India as well, especially on the jobs front, which is basically meaning productivity challenges, which means macro challenges. So that's a 10-year view, could be really different. But if I look at the next 12 to 18-month view, I use the word, it's wrong to use the word beneficiary. India is definitely less impacted with whatever is happening in the world. And that's because of the unfortunate reality of us having relatively lower trade linkages, right? On the services side, you could argue that, there could be risks to IT services and what might happen. Yes, that's more because of AI, not because of, what Trump might do. And simply because, remember that a lot of US tech companies have made a base in India, and we have allowed all US tech companies to operate in India, not China. So we do have some degree of a policy buffer saying that, look, in the tech sector, we are also giving you something, so you give us something. So put in all of these factors, I do believe India will navigate the tariff thing fairly well. But, this extrapolating this to saying that India would be the next China, there will be supply chain shifts into India, will be the biggest manufacturer in 10 years or 5 years. It is not going to happen that way. It is not easy.
Near term, Venu, the big problem which actually led us to the fall since last October to this Feb, earnings. Do you think the EPS destruction is behind us?
Last set of cuts, which are because of lethargy and laziness of all of us, is going to happen now. But incrementally, if I say it, there are very few sectors where there are risk to earnings. And especially those sectors are global facing sectors at this juncture. On an overarching basis, I would probably say that earnings cuts in terms of incremental intensity are relatively lower. Remember when macro improves and liquidity starts to improve, rates starts to come down, there's a push from the government as well, you should ideally not see large scale cuts. So that's the way I would probably model it, in terms of growth as well.
So good having you on the show today. Thanks so much for your time.
Thanks.
Right, and we move on to the management of Canfin Homes.
Well, yes.